In the 2002 Berkshire Hathaway annual shareholder meeting, Warren Buffett and his longtime business partner Charlie Munger said that real estate is a lousy investment for them.
We don't have any competitive advantage over experienced real estate investors. By its nature, real estate tends to be a very lousy investment for people who are taxed under subchapter C of the code relating to corporations.
Doesn't that make you wonder if two of the best investors of all time who've accumulated billions of dollars say that real estate's a lousy investment for them? Should you and I, as small investors, even bother with it? Well, 18 years ago, not too long after that annual meeting, thankfully I didn't listen to what was best for Buffett, and I did the exact opposite. I did invest in real estate, and because of that, I'm well over $1 million wealthier. In the rest of this video, I'm going to explain why Warren Buffett and Charlie Munger didn't like real estate investing, but then I'm going to explain why for you and me as small and mighty real estate investors, it's one of the best approaches to build wealth so that you can get out of the financial rat race. If we haven't met yet, my name is Chad Carson. You can also call me Coach, and this is a channel all about getting out of the financial grind and doing more of what matters. For example, my wife and I used passive real estate income to take a trip in 2017 to Ecuador with our kids. And I'm here on this channel to help you do more of whatever matters in your life. Here's the thing about Warren Buffett. He's one of my favorite investors and someone I've studied for years through his annual reports, through his biography called The Snowball, and also through a really good book about him called The Warren Buffett Way. But to get the most out of Warren Buffett's lessons, you have to translate them to the reality that you and I experience. Warren Buffett's company, Berkshire Hathaway, is set up as a very large conglomerate corporation that has to do transactions in the billions of dollars. But you and I are what I like to call small and mighty investors because we can do just fine buying one or two properties at a time. And we usually buy those properties either in our own name or a very simple corporation called an LLC. But instead of this being a disadvantage, we small investors have a secret advantage. We can be nimble enough, flexible enough to buy individual properties that Warren Buffett and other larger investors never could. Let me explain by going back to the clips from the annual meeting.
We don't have any competitive advantage over experienced real estate investors in the field, and we wouldn't have if we were operating with our own money as a partnership.
The key phrase from Charlie Munger just now was competitive advantage. With business and investing, it's a lot like sports. If you were an NFL coach with your football team, you would ask yourself, how can we be any better than another team? What advantage, what competitive advantage do we have? And in sports like football, you might say that our team is faster, maybe we're stronger, maybe we have more experience, maybe we're in better condition, so we're going to last longer into the fourth quarter. Well, when you look at your business or your investing strategy, Warren Buffett and Berkshire Hathaway have a lot of cash. They are very liquid so that when things get bad, when there's blood in the streets and everybody else is fearful, this is what Warren Buffett says, that's when he actually gets in and starts buying properties. So he's a contrarian thinker, he's a long-term thinker, and has a long-term perspective. Those are his advantages. But as Charlie Munger just said, they don't have a competitive advantage in local real estate markets. And that's the key with real estate. Real estate, there is no such thing as a national real estate market. There's the Federal Reserve, there are interest rates that are all national in nature, but real estate markets are different from the regional level, like a Metro Atlanta or Metro New York, all the way down to the neighborhood level, even the street by street level. Each little neighborhood is different. And so that's actually a competitive advantage for you as a small real estate investor. The key for you, and this is what I've done in my own market, is to become a local expert. Even if you're brand new, don't let that intimidate you. You can just understand a very small slice of the market. It could be one street, it could be one neighborhood. But if you become really good at that, then you'll have an advantage over even the biggest of investors like Warren Buffett. So let me give you a couple of examples of how you can become a local expert and how this has worked with my own business. I'm in Clemson, South Carolina. It's a small college town in between Atlanta and Charlotte in the upstate of South Carolina. And the university is the main employer. And I rent to a lot of students and faculty members. And I've noticed over the years that Clemson, where I am, that's the center of things, gets more and more expensive. And this happens all over the country where the most desirable place or kind of the center of your town, the properties become a lot more expensive to the point where they're unaffordable for a lot of people who want to live there. So that happened here as well, where just a faculty member like a professor or somebody who's working on campus couldn't afford to buy a house or rent a house here in Clemson. And so what I did was I started noticing that the people who were looking for houses here, if they couldn't afford them, there was a spillover effect where that demand for properties in Clemson spilled over into some of the neighboring towns, some of the neighboring zip codes. So specifically, I would look at Seneca, Central, Pendleton. These are towns right next to Clemson, and start noticing where are people buying who would traditionally buy in Clemson. And so getting ahead of that curve, we would buy properties in those locations, knowing that other people are going to realize that at some point the prices are going to start rising. You're going to start having more demand for rentals. And that's an example of of paying attention to the local market. How do you figure that out? You talk to local real estate agents. You talk to property managers. You read the local news. I have an old-fashioned newspaper that I order in my area just to see what trends are going on. So all of these local pieces of information, both one-on-one talking to people, but also reading news, gives you a knowledge advantage, a competitive advantage in a market. So if you're willing to study and go deep on a local market, you as a small investor can build a competitive advantage over much larger investors just like Warren Buffett. But a local competitive advantage wasn't the only reason that Warren Buffett didn't invest in real estate. Another was taxes.
And if you operate as a corporation such as ours, which is taxable under Chapter C of the Internal Revenue Code, you get a whole layer of corporate taxes between the real estate income and the use of the income by the people who own the real estate.
When you run a business or you start investing, there are a few different ways that you can organize that business. You can just do it in your own name. That's called a sole proprietorship, which means you don't have any kind of corporation. You could also start a partnership. So you have a friend or a family member who wants to go into business with you. And so kind of like the sole proprietorship is without a corporation, but just the two of you have some kind of agreement together. But then there are these corporate structures. And I'm not going to go into depth on each one of those, but there are names like a limited liability corporation, an LLC. There's something called an S corporation, and then finally a C corporation, which is what you typically hear about when you hear corporations. So if you think about Starbucks, Microsoft, Apple Computer, those are all C corporations. There's a lot of benefits and there's reasons why they start a corporation or run a corporation in that entity. But one of the negatives is, as Warren Buffett and Charlie Munger talked about, is that if you own real estate, you're at a disadvantage. There's something called double taxation. So on the corporate level, if you make $10,000 in a corporation, you have to pay taxes on that $10,000 at the corporate level. But then if you want to get that money to your owners of the business in what's called a dividend, when you pay that dividend, the owners also pay taxes on it. So there's taxes at two different levels. On the other hand, though, most businesses that own real estate investments, or you and I on a smaller level, we do not have that double taxation. There are special ways to do that in the tax code. So on the one hand, there's something called a real estate investment trust, a REIT, and there are a lot of details on how those are structured that are beyond the purview of this video. The main point is they can either start an LLC or a corporation, and if they follow all the rules of REITs, then they don't pay taxes at the corporate level. They just distribute most of the money or all the money to their shareholders, who then pay taxes at their level, on the personal level. And then also on a personal level, though, you and I could own real estate. We could either own it in our own name, we could own it in an LLC, which is very common for a lot of real estate investors. And in both of those cases, you don't pay taxes at the corporate level. You just pay taxes once. So that is a big deal. And I want to show you an example of the numbers of the difference between owning a property in a corporation and owning it in your own name or in an LLC. Now let's say in this example that you have $100,000 to invest and you're going to buy investment properties. And let's just say you buy 4 properties by putting $25,000 down on each of the properties, and then you borrow money or get a mortgage to fund the balance of your purchases. So you have 2 different scenarios in this example on how you could buy those properties. One, you could put the $100,000 into a C corporation, which is the same entity that Berkshire Hathaway is and Warren Buffett talked about. The other is you could either buy it in your own name or an LLC, but the common theme is you would not pay any taxes at the corporate level. Now I'm going to simplify things just a little bit to make this example easier to understand, but let's just say that in both scenarios, you make a 10% return on your original down payment. Now let's look at the C corporation scenario. You would have to pay corporate taxes. And I know this rate changes all the time. I think as I'm recording this is in the rate's in the low 20s, but let's just for simplicity's sake, say that at the time, the corporate tax rate is 25%. So every year when you make that profit, then you have to pay 25% on the corporate level. And let's say you distributed all your profits to you, the owner of that corporation, and you would pay taxes on that as well, on the dividend that you receive. So you pay 25% on the corporate level profits, and then when you distribute it, you're gonna pay, let's say 20%. Like, it's gonna depend on your tax rate and what bracket you're in, but you have 20% personally, 25% on the corporate level. So when you total those up, you're paying a total of 45% tax. Instead of making a 10% return, you actually have to subtract that 45% tax. You would actually make a 5.5% return each year on the amount of money you make inside the corporation. Now let's take the other scenario where you either own it in your own name or an LLC that's not taxed at the corporate level. You make that same 10% return, that's your profit that you make that year, and you don't pay any corporate taxes. You just pay the 20% tax on your personal income. So you actually made 10% return total. After you subtract your taxes of 20%, you actually make an 8% return after tax. Now the difference between a 5.5% net return on the one hand and an 8% return on the other might not seem like that big a difference on the front end, but if you look in the future, if you start compounding this over time and you hold this property for 10 years or 20 years, it makes an enormous difference on how much you actually end up with in the end, which is the whole point, right? If you're investing, you want to have as much wealth as possible in the future so that you can use that to have financial independence, to pay for your bills, to have freedom from having to work for a job. So let me show you in a financial calculator in my phone what those future numbers would look like in both those scenarios. So in the C corporation scenario, I start off by investing $100,000 and I make a 5.5% return every single year. And what I really want to figure out is in 10 years, what will I have left over? That's also known as a future value. So I use this financial calculator and I figure out what that future value is, and I end up having $171,000 10 years from now. Now, if I change that time period and I say, instead of 10 years, let's see what that is 20 years from now, I can change that factor. And then what I find out is that 20 years from now, I'll have $292,000. So I started with 100,000, 10 years, I have 171,000, and 20 years, I'll have 292,000 because I'm getting 5.5% return per year. So now let's look at the scenario where I still invest 100,000, but I'm investing it personally or with an LLC that doesn't have a corporate tax. So I start off the same calculation, $100,000 in the beginning, but this time I'm making an 8% return, and I'm doing it over 10 years to start off. And in 10 years, the future value of that will be $216,000. So you remember in the other example, it was 171,000. This is 216,000. That's a $45,000 difference for 10 years. But now let's look at 20 years. 20 years from now, if I invest 100,000 in the beginning and make an 8% return, I'll make 466,000. That's how much I'll have in that future 20 years from now. So let's look at the difference there. The big difference is 466,000 in scenario B, where I'm using my own name or I'm investing in an LLC. In the other case, that's $292,000. That is a difference 20 years from now of $174,000. So that is a simple example to show you what Warren Buffett and Charlie Munger meant by having a strong disadvantage in their corporate structure of a C corporation of investing in real estate. This example has shown that taxes really make a difference with your investments and that you want to choose carefully what kind of entity or what kind of organization you use to invest in real estate. But I also want to say that there's a lot of other tax benefits to investing in real estate that we didn't even cover here. This includes things like depreciation, 1031 exchanges, something called a live-in flip where you can live in a property for 2 years and actually not pay any taxes on it if you were to resell it and have a higher value, and lots more. And if you want to find more details about these tax advantages, I have another video that I've done, and I'll have a link in the video description, called the 10 incredible tax benefits of investing in real estate. There was one other issue and a reason they didn't invest in real estate, and that was pricing, that they couldn't get as good of deals buying real estate as they could in other places.
Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time.
When Buffett talks about pricing, that's really a fancy way of saying, I want a deal. Warren Buffett wants what's called a margin of safety. He wants to know that he's buying it well below the long-term intrinsic value of that company that he's buying. And when he looks at investment real estate, particularly the type that he could afford, the larger properties, there's just a lot of competition. There's lots of REITs, we talked about those earlier, real estate investment trusts, and other big money institutions that are trying to buy the same thing he's buying, particularly if they're what's called a stabilized real estate asset. So they're already fixed up, they're in good shape, they're in a bigger city with lots of jobs, they're in a good location. So those best properties, those stabilized properties that don't have any problems, there's a lot of competition for them. Therefore, it's really hard to get a deal that Warren Buffett's looking for. So what's different about you and me as small investors, and how can we find deals or get a good price on a property if somebody like Warren Buffett says that's not an advantage for him? Well, there's a couple reasons why. One is that we are willing to look at smaller deals. If you are a very large institution like Berkshire Hathaway, you have to invest billions of dollars at a time to make it worth your time. And even with smaller companies and smaller institutions that buy real estate, looking at it one property at a time, like a $100,000 property or a $200,000 property, like a single family house, a duplex or a triplex, is really not worth their time to do one at a time. Whereas for you and me, buying one or two deals per year that are good deals for us could be very much worth our time. The other issue is he mentioned stabilized properties. So finding properties that are in the best locations, they call that A-class kind of locations, that are already fixed up, that are already rented. That's what a lot of institutional investors are looking for. But what if you're willing to be more entrepreneurial and actually find problems that you could get paid for? There was a mentor of mine when I first started investing. His name is Dr. Stone, and he told me a story about finding the best deals in real estate. And he said it like this. He said, Chad, it's kind of like when you find a great dog. You know, this dog that it's like a lab, or it's a very cute dog. It has a lot of potential, but it's got a lot of fleas on it. He's like, that's what you want. You want to find a good dog with fleas. So you want to find a good potential property in a good potential location, but there's some problem with it. Because as entrepreneurs, as real estate entrepreneurs on a small scale, we get paid for solving problems. So what are some, quote, fleas that we could find with real estate investing? We might find property problems. So a typical one is a fixer-upper property. Maybe the property is just really ugly because it's not clean, because the yard's not good. So cosmetically changing something about the colors, about the yard, that's one way to solve a problem. Another way is that there's structural issues. I've bought properties where, just last year, bought a rental property where you walked in the front door and you almost fell into the crawl space because the flooring underneath it was rotted out. So not a lot of people are gonna be able to buy that house if they're gonna move into it and get an institutional loan. So that cuts out a lot of the market of people who are willing to do that. Now, I have to solve that problem. I've got to get team members who can help me fix those things and help me inspect that property to put a cost on that. And in my case, it was about $25,000 to fix all of the flooring systems, to redo some plumbing under there that had caused a leak. So those are problems. Those are fleas that you can solve with the property itself. Sometimes, on the other hand, though, there are people problems. There might be a perfectly good property in a good location, but the people have problems. We've bought properties from people who are going through a divorce, and neither one of the parties were willing to put money into the property to fix it up and get full value out of it. They just wanted to get cash and just move on for personal reasons. There have been times when somebody inherited a property. There's 3 heirs all over the country. They didn't want to put money into it and fix it up. They could have gotten more value out of it, but it's just a situation where selling it as is, moving on, made sense for them. But remember, a good dog with fleas is how we, as a small investor, can find opportunity to make money and spend our time and our energy and our intelligence to find properties that make us money, where a larger institutional investor might not be willing to do that. So Warren Buffett and Charlie Munger said that real estate was a lousy investment for them. And now you can see why that's the case. But I hope you also see the takeaway here is that for you and me, the small and mighty real estate investor, real estate can give us the best competitive advantage we can have, because we can go small on a local level, become an expert on our neighborhood, on our street, on our region of the country where we're investing. We can also take advantage of the tax benefits of real estate. In particular, the types of structures we use, the organizations we use to buy our properties can be even more advantageous than big, huge corporations. And then we have a pricing advantage. We can go out and find deals, those good dogs that have fleas. We can find those and solve those problems so that we can make money on properties that others might not be able to do. So if you like this video and my focus on the small and mighty real estate investor, I think you'll also like my next video, which is called Big Real Estate Empires Are Overrated. Go small or go home. And that's really the story of my own investing journey, starting as a brand new investor, building up a pretty big real estate empire, but then making some realizations about what it was that I really wanted, lifestyle, and how to build a business around that. So check it out. There'll be a link in the video description below. You'll also see a video somewhere here above me in a second where you can click on that as well.